Good afternoon, everyone, and welcome to another webinar that Keiter is putting on, focused on the most recent legislation signed into law on December 27th. This webinar will focus on the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act, or HHSB Act, which is a portion of the bill that was signed into law on the 27th. I want to first take a moment to introduce myself and Keiter. Since forming in 1978, Keiter has become one of the largest accounting and consulting firms in Virginia. My name is Scott Zickafus, and I'm a partner in Keiter's Tax and Transaction Advisory Services. Along with Matt Austin, a managing director in Keiter Advisors, I lead the firm's initiatives around the Paycheck Protection Program. Our objective in putting together this webinar is to inform our clients and community of ways to obtain some liquidity in this uncertain time. Our webinar is going to focus on the Paycheck Protection Program, but it's important to know that Keiter's team is experienced in assisting clients in a variety of strategic ways. We would welcome a chance to discuss your business's situation and ways that Keiter may be able to support you if the Paycheck Protection Program isn't right. Before we get into the meat of this new act, I do want to highlight that this information discussed here is preliminary in nature. It's based on the actual text of the new act and is subject to change as we get clarification and guidance. The act itself allows Treasury 7 days to issue new guidance. If the last process is any indication, we can expect Treasury to utilize its rulemaking authority and introduce new concepts and regulations that are not a part of the act itself. Keiter is committed to staying on top of these new developments and communicating them, likely by publishing on our blog. For those of you not receiving our communications, you'll see ways to engage with our content at the end of this presentation. The agenda for our presentation today is to first talk about changes that were made to the Paycheck Protection Program in general, which includes loans that already have been issued and the covered period has already ended. We'll then talk about ways to qualify for what's being called the second draw of a PPP loan, so a second PPP loan. We'll talk about the underlying calculations of the program, and then we'll end with some other items that may be in the bill that are important to consider as other means of obtaining liquidity at these times. So probably the biggest thing that came out of the new act as it relates to original PPP loans is the tax treatment of the forgiveness of covered loans. Congress had always expressed its intent to make this non-taxable, but the Internal Revenue Service and Treasury came out with some rulings indicating that though the forgiveness would be not taxable, the expenses would be non-deductible, thus causing a tax on the forgiveness. Treasury has now legislatively indicated that it will not be taxable, so that the forgiveness is still tax exempt and the expenses are now deductible. So that's a favorable outcome for borrowers that already had one PPP loan and hopefully had that loan forgiven or are in the process of forgiving it. Additionally, they expanded the allowable uses categories. So it used to be just payroll, rent, utilities, and interest, and now they introduced some new categories. So we'll go into more detail about these new categories of expenses. Those categories apply to loans that will be issued, so these new rounds of loans, but also any loan that was an original PPP loan that has not been forgiven yet can include these expanded definitions in their application. The program did confirm that borrowers can elect between a cover period between 8 and 24 weeks. We knew that by way of an FAQ that came out, but this kind of got inserted into the new act. And then finally, the simplified forgiveness that was available for loans up to $50,000 is now available for loans up to $150,000. So they kind of expanded the amount of loans that will qualify for this simplified forgiveness. The first new use that's allowable for PPP funds for forgiveness is a covered operational expenditures. So here's the definition that they use, but it's software and cloud computing services. There are things that help you with payroll, tracking inventory, processing, service delivery, all of these different things. So we can think about ways that businesses augmented or had to pivot to go in a more virtual environment. And this category seems to capitalize on that. So that's a good category. The second one is covered property damage, not really related directly to COVID, but any cost that was not reimbursed by insurance or otherwise that was a result of vandalism or looting during 2020. So any civil unrest or anything like that that was unreimbursed is now an allowable use for the PPP. We also have a category called covered supplier costs. This one's a little broader, and in order for a supplier cost to qualify, you had to, the expense has to be essential to the business operations and either pursuant to a contract that was in place before you got the loan, or it's with respect to perishable goods. So in the restaurant industry or food in general, that's one type of perishable good that might be covered by this definition, but it's likely not limited to just food. And then finally, we have the covered worker protection expenditures. We might think of those as like PPE and other modifications. This has a pretty lengthy definition around it, but these are expenses that were spent, whether capital or operating, to facilitate adapting the business to comply with various regulations that came out. They give us some examples of things that will qualify under this worker protection equipment. So the creation of drive-through windows or expansion of drive-through windows, any ventilation system or physical barriers like plexiglass, augmenting outdoor space and augmenting your space to allow for health screenings. Those are the types of things. Certain materials or filtering face pieces. You want to be careful there. It does give you some pretty specific specifications for it. So if you want to go and include those, you would want to refer to the regulations. It does not include any expenditures related to residential, real property, or intangible property. Now we get to, I think, why most of you are probably here, which is trying to understand who can qualify for this second draw or second loan, covered loan, that is being referenced in the new act. In order to qualify, you cannot receive the shuttered venue operator grant. This is a separate grant that's made available under this under the same act. We won't talk about it here, but you can think about this as live music, performing arts, those type of industries. If you can qualify for the shuttered venue operator grant, you would have to consider which one would provide you a better benefit, this second draw or the shuttered venue operator grant, and apply for one or the other. You cannot employ more than 300 employees. The previous act had a threshold of 500 employees. I put an asterisk here because it does have some carve-outs or exceptions to this rule. Namely the two would be any business that operates under the NAICS code of 72, which we knew about that exception from the original PPP loan, or the other thing that likely still applies but is not clear at this time is that the alternative size standard by which some of you may have qualified, which is a tangible net worth calculation and a quasi taxable income calculation. If you qualified under that last time, that may still be able to be used to qualify. So what I would say here is if you are a business that is greater than 300 employees, but feel like you otherwise qualify, let's hope that there's some clarification or guidance that comes out in the next couple of days that will confirm that that alternative size standard still applies. The test that you probably have heard the most about relates to gross receipts. So if your business, in order to qualify, your gross receipts during the first, second, third, or fourth quarter of 2020 has to have a decline of not less than 25% as compared to the same quarter in 2019. You'll notice that in our initial communications, we only included the first, second, and third quarter. Here I include the fourth. The fourth quarter is an available option only once the fourth quarter expires. So, starting January 1st, you'll be able to use the fourth quarter. If you were able to apply today, you would not be able to use the fourth quarter. So that's just something to keep in mind for those that might rely on the fourth quarter. And there's also language in here that if you applied for a PPP loan to begin with, you have to have used or will use the full amount of that original PPP loan before you can apply for a second PPP loan. The categories of businesses that are eligible relies heavily on the same qualifications originally. There's a few expanded eligibility categories that we'll talk about later, but the general descriptions of the businesses, nonprofit organization, housing cooperatives, self-employed individuals, all of those, it relies on the same language. There are some exclusions for publicly traded companies. And a key here is that you must have been in operation as of February 15th, 2020 to be able to apply. So if you were in operation in February 15th, 2020, we'll talk about how to go about figuring out your loan size, but that's kind of the bright line test. Any business that was in operations only after February 15th, 2020 will not qualify for this. One thing that we need to be cognizant of here is that some of the certifications were removed as part of this new act, but it seems to imply that the certification of economic uncertainty is still going to be required in filling this out. So we'll want to make sure that we give thought to making that certification and what that means. So if we think back to April, those that made the certification in April will likely need to think about whether or not they can still make that same certification of economic uncertainty. The other certification that doesn't seem to have been removed is that you will use these funds to preserve jobs. So those are the two things that we'll want to reevaluate and kind of reconfirm as part of the application process. So we have some questions that have come in about how do you define gross receipts? And so the questions might mean, do we use cash or accrual? Do we use, what if we're a fiscal client? Do we use calendar year quarters or, and what I would say there is that when they granted Treasury 7 days to come up with any new regulations, I feel like the definition around revenue and loss of revenue is probably the newest concept in the PPP that would warrant the most discussion. From Treasury or the most guidance. The SBA has some definitions around gross receipts already for its lending programs, and that one relies on accrual basis income, even if you're a cash basis taxpayer. And it also includes non-operating gross receipts. So you can think about interest, dividends, things like that. If you have a portfolio within the company that generates that, the SBA's definition includes that. It does exclude capital gains in determining it. But with that being said, I think the main takeaway here is that definitions around gross receipts and kind of the timing of that is probably the most undefined part of this program because it wasn't a part of the original program. So when we got frequently asked questions and interim final rulings throughout the last 9 months, the concept of gross receipts was not one that was discussed. So hopefully we'll get some more information there. There's some new eligibility that for organizations that weren't previously eligible. So FCC license holders and newspapers, there's some certain size limitations and certifications that they'll need to make to be able to access these funds. But they are now eligible and they given certain certifications and they weren't previously. So that if you're in one of those categories, definitely reach out because we can help talk you through that. The other is a 501c6. Those were previously excluded. Now subject to limits on lobbying revenue and expenses, and kind of a carve out for professional sports leagues and campaign organizations. 501c6 organizations are explicitly called out as eligible for the second draw. And then the final category is a new one called destination marketing organizations. They have the same limitations on lobbying revenues and expenses. And you can see that they're required to be registered as a 501c organization, a quasi-government entity, or a part of a state or local government. So, these are three new categories. We know less about the specifics of them because they are new, but I did want to highlight that there is an expansion of eligibility as compared to the original purpose. And here I just point out again that your business did not have to be in operation as of 2019, but it does need to be in business in operation by February 15th of 2020. And if you started and don't have comparison for the full calendar year 2019, the guidance allows you to compare quarterly gross receipts to the first quarter of 2020. So if you started in the first quarter of 2020, you can compare Q2 of 2020 to Q1 of 2020. You don't have to look backwards to 2019 because that didn't exist. So if you have an odd situation or you're a new business, definitely reach out because there's some guidance about how to, one, calculate the loan, and two, kind of determine if you can qualify. The same attributes that were prohibited in the initial PPP loan are still applicable here. So it's section 120.110. You can think about passive businesses, casinos, lobbying, things like that were excluded originally. Those are also still excluded. You can't be engaged in political or lobbying activities, research or advocacy around public policy. And a new one is that you can't have owners or board representation of people with ties or people from the People's Republic of China or ownership related to the Special Administrative Region of Hong Kong. So there's some carve outs based on ownership and board representation there that if you have either of those, you'll want to kind of consult the new guidance to see if you can still qualify for forgiveness. We talked about it a little bit, similar to last round, the NAICS code 72. Any business operating in that, which would be like food service and hospitality, those industries have kind of special rules that allow them to measure their eligibility on a per location basis rather than a kind of affiliate-wide basis, and it waives the affiliation rules. So again, trying to target the restaurant hospitality space. And we'll talk about it later, but there's also a favorable calculation that anyone in this NAICS code 72 can use as compared to someone who's not in that business code. The calculations that go into determining the loan size, for normal or for everyone outside of the NAICS 72, the calculation is the lesser of 2.5 months of average payroll costs or $2 million. This concept is somewhat similar to the last round, right? It was 2.5 months of average payroll, but the cap was 10 million. So they brought the cap down to 2 million. You can continue to use the average payroll based on 2019, which is what a lot of you likely did to get the original loan, or you can update it to use a 12-month period ending immediately prior to the loan application. So if for some reason you want to use 2020 as determining average payroll, you have the option to do that. And Treasury is going to issue guidance. It gives the act itself gives 17 days to issue guidance on how to increase the original loan size. So some of you may have applied for an original loan, back in April, May, June, and based on subsequent guidance, realized that you could have borrowed more, but there was no means to go back and get more funds. So we saw this a lot with partnerships that had guaranteed payments paid to partners, or something that wasn't cut and dry. So Treasury the Congress acknowledges that businesses didn't necessarily get all that they were entitled to. So Treasury is supposed to issue guidance on how to get an increase to your original PPP loan if subsequent guidance would have allowed you to get more money than you originally applied for. So we don't really have any facts here, but it is something to keep in mind if you realize that you didn't get as much as you thought you should have. Those in the 72 series get to take 3.5 months of average payroll costs instead of 2.5 months. So they get an extra month of payroll or $2 million. So they're still subject to the same cap, but if you're under 2 million, you get an extra month. And again, you can use 12 months prior to the loan or the last calendar year. So, try and figure out which one's more advantageous and go with that. The idea that there was a seasonal business existed in the original act. If you go back to the CARES Act, they talked about seasonal businesses, but they did not define what a seasonal business is. And so this new act does define seasonal businesses as those that operate no more than 7 months in a year, or they earned no more than a third of its receipts in any 6 months in the prior calendar year. So you can think of having a significant lull in the business or not operating more than 7 months a year. And if you qualify as a seasonal business, you can use any 12-week period between February 15th of 2019 and February 15th of 2020 to determine your average monthly payroll. So this would be important for seasonal businesses that that monthly average on a whole year is not representative of the true payroll costs of the business. So for those of you that this resonates with, it could be an option to more appropriately size your loan. Here we talk about, I won't go into the calculation, but it does talk about if you don't have a full year period preceding February 15th of 2020, how to go into calculating it. So this would be something, we're going to offer a recording of this presentation after the fact. So that would be something that to go into, but it looks at basically the average monthly payments for the amount of time that you existed and comes up with that and then multiplies it by 2.5. Or if you were 72 series, it would ultimately be 3.5. So what a lot of you probably have come here to understand is what do we see the next steps as of right now? The next steps, as we see it, is that this program ends no later than March 31st. We say no later than because if funds are exhausted prior to that, then the program will end when the funds are exhausted, similar to the first round of PPP. We wanted you to consider changes to your average payroll costs. It might be easy to default to how you calculated it the last time, but for a lot of you, as I was mentioning, we were using imperfect information to calculate that. So we've realized that people may have gotten too much or too little based on the assumptions that they use to calculate their average payroll costs to begin with. And so do take a look at that and make sure that the way you calculate it is in compliance with the regulations now, so that you make sure that you're appropriately determining that cost. It's our recommendation, at least currently, to contact the bank where you got your first PPP loan, thinking that the process should be smoother because they have a lot of the requisite information, and it should create a quicker process for you. And then in this interim time before banks open up their portal, we're advising that you go ahead and substantiate your qualifications. So whether or not that's employee count or revenue loss, whatever it is that you need to substantiate to share that you qualify, to go ahead and try and get documentation around that to make the application process a lot smoother. We'll actually go back here. A lot of the questions talk about that we're getting from you all right now talk about what to do. Like, does the salary and hourly reduction test still apply? How do we look at that? The way that this act has been written, it essentially more so appends or modifies the original act to update language. So the presumption right now is that if there was a calculation or a method or a penalty or an evaluation, whatever it is, if that was part of the original act, unless it is specifically modified, appended, or deleted as part of this act, it will stay. So that's why we said we believe that the certification of economic uncertainty will still be required. It doesn't specifically say that in the new act, but it does not delete that certification from the original act. And so when you think about qualifications and safe harbors and all of that kind of stuff, think about it in the same context, at least currently until we get further guidance, think about it in the same context as the original PPP loan. Some of those safe harbors, Congress gave Treasury the authority to extend those safe harbors to a date that they felt was reasonable. So when we talk about like the FTE restoration and period that was through December 31st of this year, that will get updated and Treasury will indicate at what date they think is a reasonable time period to extend it to. But those are the types of things that we think we'll get when we see the new guidance issued by Treasury. So we'll definitely have more detailed content coming out later. And we'll try and address your questions. You can look at any of these websites. We have our blogs, our events, our upcoming events for other webinars that we will be hosting. And we have a newsletter that you can sign up for. That newsletter will post any new content that is related to this bill that we put on our blog will likely also come through that newsletter. So it's a great way of staying informed. And we look forward to having you all back again next time we host a webinar. So thank you all for your time. And for those of you who asked a question that we were unable to get to, we'll try and get to that through some sort of communication.